We hope your new year is off to a great start, and it's hard to believe that January is already almost behind us. I am Katrina Radenberg, Chief Investment Officer at Mariner, and I'm joined today by Jeff Krumpleman, our Chief Investment Strategist and Managing Director of our internal equity strategies. Today, Jeff and I will walk you through what mattered most in the markets in 2025, and more importantly, how we're thinking about 2026, including our economic assumptions, market expectations, and the key risks we're watching this year. In a nutshell, equity returns were impressive once again in 2025. U.S. large and small cap stocks delivered healthy gains, growth and value both performed well, and international equities did even better. It's also worth pausing on the fact that the S&P 500 just completed its third consecutive year of double-digit returns. Cumulatively, the index is up roughly 85% over the past 3 years, and as Jeff likes to say, that's a wow. As we look ahead to 2026, let's be clear right from the start. We have a constructive outlook. That's consistent with the view we held in 2023 when we were contrarian bulls amid widespread recession fears. It's also consistent with our outlook in 2024 and 2025. Sometimes our optimism has been contrarian, sometimes it's been aligned with consensus, but it's always been grounded in the data. Looking back on 2025 specifically, one important distinction between our outlook and that of many of our peers was consistency. While many firms began the year positive and then shifted repeatedly as headlines evolved, we maintained our positive stance throughout the entire year, even amid heightened anxiety around tariffs, labor market concerns, government shutdowns, Fed policy speculation, and warnings about AI-related bubbles. We stayed focused on the data rather than the noise, and that discipline is what gave us the confidence to hold our base case S&P 500 target of 6,600 and our optimistic target of 7,000 throughout the year. With the S&P 500 closing 2025 at 6845, right in the middle of that range, we were pleased to see the data ultimately confirm our conviction. We try to avoid rapid shifts in narrative driven by headlines. In our experience, that kind of whiplash can lead to premature decisions and distract us from the long-term wealth outcomes we're trying to achieve. Adjustments based on hard data or client life changes make sense. Emotional pivots driven by fear or speculation rarely do. The common thread behind our outlook in recent years has been the same. The fundamentals, valuations, and technicals, what we call the FVTs, have consistently pointed in a supportive direction. That's also why we're constructive about 2026. While we expect returns to be more modest than the past 3 years, we still see a path to low double-digit gains, returns we believe most investors would welcome. We'll dive into those specifics in just a moment, but first let me bring you in, Jeff. What would you add to what I've already covered?
Well, yeah, first, I mean, you used the word positive, quite a bit there, Katrina. So I just want to clarify, the FETs and we are not always positive. And 2022 was a great example where the data was a little less constructive, and it did require a more cautious stance, some rebalancing, some strategic adjustments. And we messaged as such. So we're not always positive. But the good news here is that most of the time the data is positive. And that's because we live in a wonderful country, a lot of innovation here in the United States, and we're in economic expansion roughly 87% of the time, based on history. We're in a recession 13% of the time. So most of the time, earnings are growing, the economy's growing, and therefore the stock market is up close to 80% of the time in the United States. So it pays to be positive when the FETs warrant it, as they did in 23, 24, 25, and we think, once again in 26. So we can get crabby and cautious when the data sours, but it looks pretty good, and that's our message as we go into 26. That's one of the things I'd add. And then the second thing would be, you mentioned the fact that the market's been up 3 consecutive years, something like 85% cumulatively. I want to just put that in perspective because a three-peat doesn't happen all that often. If you look at the history of the S&P 500 going back 95 years, we've only had 3 consecutive years of double-digit return, this three-peat, 5 times. And I was born and raised in Kentucky, and so horse racing, is a big thing in the state of Kentucky. And for a little additional perspective, we could look at horse racing statistics. And if you look at Triple Crown winners, we've only had 5 Triple Crown winners over the last close to 100 years in horse racing, or actually, since 1950, certainly that's the case. So this idea of a three-peat is actually rarer than you see three-peats in thoroughbred, horse racing, which is really tough to do. So that begs the question, what we're out here saying 7,700 for 2026, which would make it a four-peat. And that's only happened 3 times in the history of the S&P 500. So there might be those who will say, hey, man, that sounds pretty aggressive. And we think not. We think it's very realistic. And again, it's grounded in this data, the FETs that we're going to review with folks. So we're positive, we think, for good reason.
Great perspective. Thank you, Jeff.
Sure.
So before we move fully into the forecasts, I do want to spend a moment grounding us in what actually happened in 2025, because I think that sets the table for everything that follows. So if you look here on this slide at the far right column, it's hard really not to smile and be excited about what we saw. The S&P 500 was up nearly 18%. Developed international and emerging market equities were both up over 30%. Growth and value each delivered mid to high teen returns, and even small cap stocks, which had lagged for several years, advanced at a mid-teens pace and reached new highs. So these gains were supported by strong earnings, steady economic growth, cooling inflation, stabilizing inflation expectations, and a measured Federal Reserve. Importantly, these returns were driven by earnings growth, not multiple expansion. That said, 2025 was anything but a straight line higher. We experienced several sharp pullbacks, particularly in the first quarter, followed by strong recoveries. That pattern aligned almost perfectly with our clear air turbulence thesis from this time last year, a profitable year overall, but one punctuated by temporary air pockets along the way. Tariff headlines and other wall of worry items unsettled markets at times, but the fundamental data ultimately carried the day and allowed markets to climb the wall of worry. The final point that I would highlight here is the broadening of market leadership, especially in the fourth quarter. Returns were no longer concentrated in just a handful of names. That broadening is a key input into our 2026 investment theme, which is the year of risk awareness and diversification 2.0. So Jeff, will you bring that theme to life for us?
Yeah, I'll do the best I can to do that. But, it really is, based upon this idea of the broadening that you said that happened. And, particularly in the fourth quarter, you saw that with regard to sector leadership within the S&P 500. You saw it with regard to domestic versus international, as international stocks did very well, and the broadening that you saw there geographically in terms of leadership. And then you saw it, with regard to just the various domestic asset classes, small cap, versus large cap, and you saw it with regard to style, growth versus value. So on the sector standpoint, it wasn't all tech in 2025. As we moved through the year, particularly in the fourth quarter, healthcare led in a big way, not technology. And in the final months, it was really financials and industrials and materials that were the leaders. And we've seen that continue in 2026, which is really a positive sign for health in the marketplace. So far this year, I just wrote down some stats here. Energy's up 13%. So far year to date, materials up 10, industrials up 6, staples up 6, com services up 3%, consumer discretionary up 2.5. The S&P's only up about 1, a little over 1.5% or so. So tech is actually negative in the first couple of weeks of this year. So from a sector standpoint, we're seeing greater breadth. If you look at the Mag 7, they underperform from November through the present. And they haven't done horribly or anything like that. It's just that it's the other 493 that are really doing well. And actually last year for the full year, the other 493 were up mid-teens, which are really solid results. You saw through the year, and particularly at the end of the year, value stocks, more cyclical stocks, come on in a big way and close that gap. And you can see by the end of the year, the gap between Russell 1000 growth and value was much tighter. So far this year, Russell 1000 value's up 4, Russell 1000 growth is up about 1. So value, is the leader. So again, this broadening. And international up 30% last year. So far this year, EFA is up 5%. Europe, Australia, Far East is up about 5%. The emerging markets are up about 10%. So international is leading versus, the U.S. Gold has been strong, throughout 25, and it's up over 20% so far this year. So the point is that while we expect the S&P 500 to do well in 2026, we really think that balance and diversification is the way to really generate constructive results in 2026. And I'll add that the catalysts that we see out there are multiple. You can see drivers of this broadening being improving sentiment in these different areas. You can see in the asset flows where money is going into these other pockets other than just technology. Policy, when you get stimulative fiscal policy, monetary stimulus or accommodation, that drives the more cyclical oriented or value oriented areas of the S&P 500 overall, and small cap versus large cap. And then finally, a weakening in the dollar is something that really can drive, international. And if you do look at relative earnings growth, where if you looked a year ago, it was all Mag 7 and all tech, where everything else, the earnings growth rate was pretty low. It's pretty equally distributed as we move through 2026. In fact, there are several quarters where it's the other 493 that outperform the Mag 7 in terms of anticipated earnings growth. So that all comes down to, Katrina, balance. You want to make sure that you're not just in S&P 500 and just in market cap S&P 500, which is very concentrated and arguably higher risk.
Very well. Thank you.
Sure.
So to close out our review of 2025, let's briefly reflect on what worked well and where we could have done better.
Okay, well, we've covered, I think, maybe a fair amount of this, but in quick summary, we got the call right on the magnitude of returns. We were looking for double-digit returns and an S&P of 6,600 to 7,000 through the year, and we were consistent in that forecast. We stayed steady through all the headline stuff and the tariff trauma and all the headlines that you talked about. We talked about having a blend between growth and value. And I think that paid off in the lower volatility and the value when things pulled back in the corrective phases of last year, and yet we maintained our growth ratings as well. And then, as I said, this year so far, value's off to a really nice start. So that blend, I think, was helpful last year. I think it will be particularly helpful this year. We pretty much nailed it. We work closely with our chief economist, Bill Greiner. Need to give him a lot of credit on his thesis last year for GDP, when we looked at interest rate expectations for Fed funds and for the 10-year, we're pretty much spot on the ranges that we expected for those categories of data. And we recommended early on that folks diversify last year. And if they were underweight international or had none, a lot of people hated international. We said, hey, we think that that's an area where you want to add to, make sure you participate. I think the only thing we missed last year was the magnitude and the persistence of the strong performance of the Mag 7. And it's not like we weren't there. We were absolutely there. But I think it did surprise us how stubbornly good they were. And as I said, it's not like they're doing poorly at all. You still want exposure there, but their relative performance flagged as we moved into the final quarter and on into 2026 so far. But yeah, overall, I think we're pretty pleased with, the report card, whatever you want to call it.
Yeah, I would say it's pretty solid. Solid scorecard for 2025. Let's do it again in 2026,
That'd be
shall we?
fun.
Okay, so now let's actually shift our focus to the outlook for 2026. So can you walk us through here what we've got on this slide through our base case expectations, the assumptions behind them, and then the alternative scenarios that we're considering as well?
Sure. And so this is a consistent slide in every crystal ball that, we do, Katrina. So if you want to fact check and look at scorecard for previous years, you can always go back and look at this. And I think we're pretty proud of the record and publishing this. So the kind of bottom line is, if you look at that, I guess that's orange. The base case expectation, we assign a 50% probability to the S&P 500 ending 2026 at 7,700, which would be a 12% price return and 13% gain if you include dividends. And it's pretty straightforward. That's based on not multiple expansion. We think that we can maintain the multiple at 22 times earnings, and it really picks the consensus earnings expectations out there at $350 a share for the S&P 500. And we think those are very realistic kind of expectations. And that earnings number of 350 is grounded in the assumptions up top on this page. We're actually looking for GDP growth to accelerate a bit in 2026 versus 2025. We're looking for a range of 225 to 275, and that might even be a little light. But over 2.5% is kind of our bias or tilt towards GDP growth next year, largely driven by the strong capital spending that we're seeing. And the affluent consumer is just in really good shape. And they drive most of the spending in our economy. They're employed, strong net worths, as their stock portfolios and real estate values are at all-time highs. So the affluent consumer is in good shape. And we have some other things that will come into play next year. Big tax refunds, or I should say this year, in the spring of this year, big tax refunds. It's the semi-quincentennial, so we have that celebration to look forward to. We host the World Cup. And I think broadly, you're going to see some very solid growth as productivity continues to increase, and the AI investments are paying off on that front. Fed funds, we think, will be in a range of 3 to 3.75%. We're at 3.75% right now. So we're saying no cuts to 2 cuts of 25 basis points each. And if you look at the 10-year Treasury, we think it should trade in kind of the consistent range it's been in of 3.5 to 5%. If you take the fact that normally 10-year Treasuries trade 75 basis points to 100 basis points over the Fed funds rate, that would get you in that range. And right now we're right about 4.25%. So that's very healthy for S&P 500 returns. And by the way, we give the Fed really high marks in what they've done in managing this risk of higher inflation or rising potential unemployment. The economy's in real good shape there. And I think it was clear with their presser yesterday that they're in pretty good command of what's going on right now. They don't need to cut based upon the economic strength we're seeing, and inflation's a little high, so they should respect that, but it's not horrible. If you look at all those assumptions, that should equate to roughly 15% S&P 500 earnings growth in 2026. And that's just about what we saw in 2025. So that's solid earnings growth, and then double digit again in 27 as that trend plays out. Now, that's where you get the 7,700. We do think things could be a little bit better. 10% probability we trade up to 8,100. And that would come from multiple expansion. You hit the earnings number of 350, but let's say that investors get a little giddy and we trade up to 23 times. We really wouldn't want to see it go a lot higher than that. That might be a time to rebalance if that would occur. But if you get 23, what could do that? Well, we are going to get some nice tax refunds. The Fed is engineering a nice landing. If we don't get, freak out on this fear about Fed independence, some confidence might come in. The tariff situation is kind of, although there's still headlines out there, it's stabilized in a realistic range. So all of those things could give a lift in confidence and a lift to the PE. Now, what could go wrong? We could see a disappointing case where we basically go nowhere and just hover about where we're at. And we put a 30% probability on that. It's not our foremost expectation, but there's a chance that could happen. And I think that's where you could hit your earnings number of 350 a share in the S&P, but you get some PE contraction. Why? Well, it's a midterm election year. People can get a little crabby, a little concerned, over that as we move through the year. There could be talk about AI bubbles and just headlines, all this temporary stuff that just could temporarily impinge psychology in the market. And that's not travesty. It's not a reason to sell. It's just people won't be in as great a Christmas mood if that's where we're at this time next year. And then you could get a pessimistic case, and that would be recession, but we think that's very low probability, 10%, and we just don't see it in the FETs right now. So the bottom line, when I look at this page, we assign a 60% probability to 7,700 or better. And if things don't go well, we think kind of the most likely worst case is flat. So that's actually a pretty good outlook, Katrina.
Yeah, it is. Thanks, Jeff. I would say the takeaway is solid returns, even though they might be more moderate, and they'll be grounded in earnings growth rather than valuation expansion. Since our outlook is anchored in the FET framework, let's now review how those metrics look today.
So I always joke about this. You're probably getting tired of it at this point because you do love yoga, Katrina, and I know you're pretty experienced in that practice. So, but the point is, I think it brings down your blood pressure, when you do that, and I think it brings down your blood pressure when we talk about this table. And so, when folks ask us what we think about the equity markets, we go to 3 levels of analysis to make our conclusion. We look at fundamentals, that's one category of data. We look at valuation levels in the center, and then we look at the technical price trends and the general sentiment out there. And we rate those 3 broad categories as neutral, negative, or positive. And then there are all kinds of subcomponents underneath those 3 categories that we also rate as positive, neutral, negative, and that rolls up into our final assessment. And, the point here is that for us to get negative, you need to see a whole bunch of minus red signs up here. And you don't see very many. You mostly see neutral in the yellow to positive in the green, as it is most of the time. So when the headlines come out that really upset folks, we go to this, and if you look at the economic trends, there's all kinds of subcomponents that we look at underneath here, but the summary would be that we do have very high levels of capital spending. As I said, the affluent consumer, and we'll go through some data in a minute, looks, very, very strong. And we have rising levels of productivity that is really driving growth. And I know people are getting crabby a little bit about labor market, but actually labor market supply demand are pretty much in equilibrium. And the slowdown in payroll growth is because we've really stopped a lot of the immigration that's going on, or that was going on earlier. And we've got a lot of baby boomers and old folks that are retiring. So you're not getting the payroll growth, but the people that are there are well paid and they're very productive. And as productivity, surged over almost 5% in Q4, people can produce more units per labor hour. And that allows companies to pay them pretty nice wage increases without impinging profit margins. That's a perfect cocktail for growth. So worst case, economic trends are neutral. I would say leaning positive as GDP looks to accelerate and as we go into this year. Earnings trends, double digit, they look great. The Fed, as I said, has done, we think, a very handsome job of managing risks, and they're in accommodative or cut mode. They've cut the Fed funds rate 175 basis points over the last 18 months. And when the Fed is in pause cut mode, the stock market responds very positively, and we'll see a chart on that in just a minute. Credit spreads are as tight as they've ever been. So bond investors are not worried about getting paid on their corporate bonds, and that's a very good signal of economic health. Valuation, quite frankly, we don't understand why people are just now getting crabby about valuation. The PE ratio was 22 times earnings on the S&P 500 going into 2025. In January of 2025 was 22 times. We exit 2025 going to 26 at 22 times. The growth in the stock market last year was not PE expansion. It was all earnings growth. So if you're going to get crabby about valuation, you should have been crabby 2 years ago, 3 years ago about valuation, not now. And when the fundamentals are solid, it's not a very good tool. Valuation alone in isolation will really play mind games with you and get you out when you shouldn't. So the average stock is trading about 17 times, which is right on the historical average. We're not concerned. We think valuation is kind of neutral. And then if you look at the technicals, there we're looking at the internal health of the stock market. Are just a few stocks going up and that's driving returns while most are going down? No. We look at the advanced decline line, the number of stocks advancing versus declining on a rolling basis, and we're hitting highs on the advanced decline ratio. It's a nice chart going up in a northeastern kind of direction on breadth of the market. If you look at momentum, the percentage of stocks trading above their 200-day moving average, it's not crazy bullish, it's not crazy bearish. It's kind of right in that neutral zone. 50 to 70% of stocks trading above their 250-day moving average, which is a very solid territory. Sentiment, you do have to be a little cautious on sentiment. We were uber bullish, kind of mid-year, and then towards the end of the year, we got more neutral. And now people are starting to get bullish again. But I can tell you, that's not a good indicator to get out of stocks. Really negative or bearish sentiment is a good reason to get in. But sentiment can stay kind of at the upper band for quite some time. And if the fundamentals are good, valuation is reasonable, the market continue to do well. So when we mix all this in a soup pot, we're neutral positive as we are most of the time. And that's why we have a constructive double-digit return view on the equity market in 2026.
Thanks, Jeff. That's a great overview. Okay, over the next few slides, I want to highlight a few specific metrics within each of those categories, fundamentals, valuations, and technicals that you just covered that really reinforce the conclusions that you just walked us through. So if we go to the next slide here, on this slide, we're looking at trends in earnings growth and profit margins, and this data continues to look very strong. On the left, you can see that the S&P 500 earnings steadily rising from roughly 240 in 2024 to about 270 in 2025 and expected to move north of 310 in 2026, with consensus estimates approaching that mid 350s in 2027. On the right, profit margins remain at record levels and continue to trend higher. The key takeaway here is simple. Earnings growth remains the primary driver of market gains, and the underlying profitability of U.S. companies is exceptionally healthy. This chart reinforces our view that earnings growth and leadership are broadening across the market, which we see as a healthy development. You can clearly see how the dominant mega 8 were in 2024, or how they were the dominant ones in 2024 and early 2025. But as we move to 2026, the earnings growth gap narrows, and in several quarters, it actually flips in favor of the other 492 stocks in the index. Jeff alluded to this earlier, but this broadening in earnings power is a key reason we believe balance and diversification matter more in 2026 than they have in more recent years. And then Jeff had also mentioned about capital spending and how that is a major pillar of economic support right now. And this slide really brings that point to life. The hockey stick shape that you see here reflects a powerful acceleration in overall capital spending, particularly in AI-related investment. We expect this momentum to continue in 2026, driven by productivity gains, competitive pressures, and incentives that were embedded in the tax bill passed in July of 2025. Our research suggests this investment cycle alone could add roughly 35 basis points to GDP growth, reinforcing our view that economic growth is more likely to accelerate than to decelerate this year. And then this slide highlights an important and often misunderstood point about valuation. While the S&P 500 trades around 22 times forward earnings, that multiple has remained relatively stable for years. Importantly, most of the market's gains in 2025 came from the earnings growth, not multiple expansion. Higher valuations today are supported by structurally higher profit margins and returns on equity compared to prior decades. It's also worth noting that the equal weight S&P 500 trades closer to 17 times earnings, suggesting that the average stock is reasonably valued and that overall index valuation is being skewed by a small number of large names. And then finally, to round out the FET framework, let's look at the technical picture. Investor sentiment has cooled meaningfully. It's no longer overly bullish, which is historically a healthy setup. Market breadth continues to improve, with the advanced decline line trending higher and reaching new highs. Momentum indicators also sit comfortably in neutral territory, not overbought, not oversold. And then taken together, the technical suggests a market that is constructive but not stretched. So a backdrop that has historically supported further gains and supports what Jeff was walking us through earlier. And now we'll shift to our wall of worry. And I want to stay here for just a moment to walk through some of the key items that we expect investors to face in 2026 and the issues likely to dominate headlines and test confidence. Some of these are familiar: speculation about Fed policy, concerns about labor market slowing, and ongoing debate around tariffs. Others, including midterm elections, AI-related fears, and geopolitical risks, are newer but no less attention-grabbing. So let me touch specifically on tariffs, since we expect renewed headlines early in 2026. After very loud threats in early 2025 to impose tariff rates north of 35%, cooler heads ultimately prevailed. Following the sharp market reaction we saw in April of 2025 when equities sold off and treasury yields spiked, the administration stepped back and tariff policy settled at an average rate of roughly 12%. The Supreme Court is currently reviewing whether these tariffs are constitutional under the International Emergency Economic Powers Act, And our view is that the court is likely to rule against their use. That said, the administration has alternative legal pathways available, which would allow tariffs to remain in place, but in a more targeted and capped form. The good news is this: even under those alternative frameworks, tariff levels are likely to remain close to current levels, which we believe are manageable and not inconsistent with our economic growth or inflation assumptions. This reinforces the broader point we've made before. Reacting too early to worst case scenarios can be costly. We prefer to stay curious and not to jump to conclusions and to let the data guide us. More broadly, we continuously evaluate all of these risks, both the long-standing ones and the newer ones, by watching how they show up in the hard data, whether that's employment trends, earnings growth, GDP, interest rates, credit spreads, and inflation. So far, history has shown that many of these wall of worry items tend to resolve in less damaging ways than initially feared. And if that changes, we trust the data will tell us that, and we will then respond accordingly. Jeff, do you want to now jump in and talk about a couple of these other risks?
Yeah, no, that's a great overview. And so let me do that very thing. So we wanted to get some data up on the Fed and show you that they really are our friend at times when they're in this kind of pause, cut mode as they are. And they did signal yesterday after being in kind of a consistent cut, and then we had a bit of a pause as we moved towards the end of the year, that risks are kind of balanced on the inflation side, and economic growth has come in way better than feared. It's actually been very robust. I think real GDP growth came in at 4.3% in Q3 and is expected to run a little over 5 in Q4. Now, that's quarter to quarter GDP growth that, is a bit volatile. But overall, we had GDP growth of, in the mid twos or better for the full year, I think, once the data comes in. We expect that, again. So this fear about labor market weakness is over advertised in our view, and you need to keep an eye on inflation, but it's okay too. And as likely as those tariffs calm and we anniversary, it's likely to go down to the Fed expected levels closer to 2.5 or 2% as we move through time. So they are either in pause or additional cut mode, depending on how this data plays out. And in that environment, look at what happens when the Fed is in this type of environment and it's not restrictive. The market's up about 20% annually when the Fed is in this position of pause cut. And so we think the Fed indeed is your friend. If we look at the next slide, Katrina, we've got stuff on the labor market, which I think maybe will, bring to life the real picture here. We've got a lot of hand-wringing over, is the labor market falling apart, and what does that mean for the economy? Is that going to be recessionary? The chart on the upper left, you can see the trend in the unemployment rate. We're right around that 4.4% level right now. It ticked down in the most recent report just a little bit. But while it's gone up over some period of time when we were in the upper threes, we're still at historic low levels in unemployment. So nothing to get extremely worried about. And the Fed and we expect it to kind of stabilize in this area. And very importantly, you've got to look at other data. It's a mosaic. It's not just the unemployment rate. If you look in the upper right, the orange line shows you when that is above the zero line, that means that real wages are growing faster than inflation. In the blue, you've got the nominal wages, but the orange is after inflation. That's positive, and they've been positive. So there's more money in our pocket to spend. That's a good thing. And if you look at the other factors on this page, like rising productivity and unit labor costs were just reported today. They were negative. unit labor costs are going down because productivity is surging up. So you're able to pay higher wages, but because you're producing more output, the actual cost per hour in goods produced is falling. That's a wonderful equation, and we think that that will be a driver of margins and growth in the U.S. economy. And then to go to the next page, you know, you can make all kinds of and have thoughts and comments about distribution of wealth in the U.S. And it is becoming more and more unevenly distributed. The wealthier are getting wealthier, those at the mid and lower end not enjoying that to the degree they should. But that's a social kind of issue that we need to address and really look at that. But in terms of what is driving consumer spending and the stock market, affluent folks remain employed. They have record levels of net worth because stock prices are high and home prices continue to be at high levels, and they do most of the spending. And so we just wanted to show you, yes, it's true. If you look at the lower end, lower households with lower income levels, you're not seeing dramatic growth in spending there, but you are in the affluent, and that's what really drives the economy and equities. So we want to make that point, and we need to address the social challenge here. But if you're talking about what do you think is going to happen to the S&P 500 next year, this is what really moves that. You look at the next slide. The other wall worry issue that a lot of people talk about is, oh my gosh, Jeff, Katrina, is this 2000? And we're just there to say no, it's not. And we do think we're in the early phases of this AI adoption and just revolutionary shifts that this is going to make. And I don't think that's drinking the Kool-Aid. I think that's reality. We could share with you what we do at our company and what healthcare companies are doing. It's just dramatic in terms of adopting AI. But in terms of valuation, as people go, oh, are we in a bubble? If you look at the left, that's the forward PE of the largest companies in technology in the S&P 500 at year-end 2025. You hardly see there's one above 50. Most of them are tightly contained in that 50 and below area. I think the average is, somewhere around 35 or something like that. Look at how it was back in 2000. My goodness, you had a whole bunch of stocks trading at close to 150 times earnings, close to 100, well over the 50. So I'm not here to say that, this won't evolve into a bubble at some point. We'll watch for that. But right now, the cash flow of these companies, the earnings levels, their ability to invest is extremely strong. You saw in some of the earnings reports that came out today on the part of the tech titans. So we don't think we're in a bubble. And I think we may have another slide here. Midterm elections, that is something that, we need to deal with it, in 2026 as a potential headwind or driver of volatility, but that's what it is. It's not the creator of a bear market. What this chart shows you here, the blue lines show you in the various years of a election cycle, the maximum intra-year drawdown or the average maximum intra-year drawdown in those years. So in year two, which is a midterm election year in the election cycle, the S&P 500 on average corrects 19.4%. In the other years, the other 3 years of the 4-year election cycle, you get lower drawdowns. People just get a little more nervous about, oh my God, are we going to have a change in policy? And what does that mean? And so on and so forth. And so as we near, right now, it sounds like there will be significant congressional change. People will probably, think about that a little bit, and it may give pause, but that is very short-lived stuff, and is likely to result in gridlock in many cases, and that's why you see the follow-on in the 12 months following those intra-year drawdowns in those midterm election years. on average, the market is up 31% in the ensuing 12 months. Why? Because the FETs are pretty solid. So people say, okay, let's forget the election cycle. Let's focus on what Jeff and Katrina focus on, and they look pretty darn good as an investor. We put this up here. I just wanted, this gives you a sense that while, you might, a lot of stuff you read in the headlines is about fear and slowdown and, oh my gosh, what if this happens and what's that going to mean to the global economy? Yields across the globe are in an uptrend, not dangerously so, in kind of a steady fashion, but that means that people recognize that there's some acceleration and growth going on in the US and globally right now. And that's part of the reason why we think that you want to be balanced and diversified, because growth is not just here, it's also in the US. So that's reflected in rising global yields that are trending up. Now, they can reach a point where you might say, yields are getting too high. Does that mean the bond vigilantes are out there, or will that impact growth? Certainly not at these levels. At these levels, we call it a positive sign. But I just wanted to point that out, that generally, we're looking for rising productivity, rising growth, and that's part of the thesis for RAD, or risk awareness and diversification and greater balance in 2026.
Awesome. Thank you, Jeff. So I'm going to take us into wrap up here. This is a slide that is not new to many of you that are tuning in regularly with us. And this slide really reinforces a simple but powerful truth, that over time it pays to stay invested. Most years, as Jeff already talked about earlier in this presentation, deliver positive returns. Down years are actually relatively rare, and when they do occur, the losses tend to be manageable, particularly within a well-constructed plan and portfolio. What matters most is discipline. Staying anchored to the fundamentals, the valuations, and the technicals, rather than reacting to the headlines that generate fear, but rarely alter the long-term outcomes that we're focused on helping you achieve. That disciplined approach has served our clients well, and it continues to guide how we're positioned today. So I want to thank you all for spending time with us today, for your trust in us. And if you would like to connect with us further from here, this is how you can reach us. And we just truly appreciate your trust in us, your taking time out of your day to hear what we've got to say. And we really look forward to reconnecting mid-year to see how the data and the markets are unfolding. Thank you.